I don't know. It's recording now. Ah, all right. So our CF0 is our equipment and our working capital, $2,840,000. All right, so for those of you who didn't tune in live, I didn't hit the record button early enough. And so let me go through. We're looking at comprehensive problem number 2. It starts a construction company is considering expanding. And this problem is posted on Canvas. So we're going through and we have to set up 2 tables. One is for cash flows and let's see, there are 2 people waiting to join. Hold on one sec. Let's get these people in. All right, I think that'll do. There's one other person. Okay. Let me get this cursor out of the way. Okay, so, and this is what your problem is going to look like on the final exam. There are 65 questions on the final. And the first 25 questions are all quantitative questions that relate to this kind of problem, this comprehensive kind of problem where you have information about the cash flows and information about that you need to determine WACC, okay? And again, the cash flows, you have CF0, that's cash flow at time 0, and that's your net capital spending, and it is your net working capital. Your net capital spending is your property, plant, and equipment, and your net working capital are your short-term expenses that you will incur before you start the cash flow. So we added up all the equipment costs. Okay? If you go through the problem, you can see all the equipment costs, and the equipment's $1,940,000. All that's going to be depreciated over 10 years. So our depreciation expense, which will be in our operating cash flows, it will not be in our cash outflows, CF0, but it will be on our operating cash flows, $194,000. That's $1,940,000 divided by 10. No salvage value, 10 years. And then we add up our short-term expenses. And so we have our CF0, which is on our cash flow table, which is $1,940,000 plus $900,000. $2,840,000 is the cash outflow. Okay, so let's go ahead and put that up here, $2,840,000. And also let's put depreciation is $194,000. Can y'all see that up there? Yeah. All right, so now I'm going to erase the rest of this because now we're moving on to a different section. Now we're going to do our operating cash flows. Okay, so we have our CF0, and now we're going to do our operating cash flow. Any questions yet? No? I need somebody to answer me. Questions? I can't hear anybody.
No.
Okay, I just heard somebody. All right, thank you. I need y'all to speak up for me. All right, so let's go ahead and do our operating cash flow. So operating cash flow is EBIT plus depreciation minus taxes. Okay. And so to get EBIT, we're going to have to do an income statement. So we have sales, cost of goods sold, gross profit, SG&A, depreciation, EBIT, and taxes. Okay. And so let's see. They think that this company, so it's a service company doing excavation work, clearing land and so forth, 12 projects per year and an average price of $250,000 per project. So 12 times 250,000 is, what's that, $1,250,000? No, how much is that? No, that's 2,750,000. Somebody do that. Take your calculator out. I can't hear you.
I got 3 million.
Hold on, let me turn the volume up here and let me see if I got a volume issue going on here. Let's see if I can. All right, speak up.
I think it's 3 million.
There we go. 3 million? All right, thank you. Now, cost of goods sold, $100,000 per project. So 100,000 times 12 is 1,200,000. All right, so gross profit is 1,800,000. All right, SG&A is going to be 35,000 plus 200,000. So that's going to be 235,000. SG&A is 235,000. Okay. And then depreciation is 194,000. Okay. I think that'll get it. Now it says, wait a minute. Fuel and insurance, 200,000. So we got the 35,000 in there. Oh no, I'm sorry, I got that wrong. So it's 35,000. SG&A is 35,000 times 12. Somebody do that. 35,000 times 12. How much is that?
420,000.
Okay, so that's 420,000 plus 200,000 is 620,000. I think that's it. 35,000 fuel and insurance, labor, overhead. Now, the 200,000 to maintain and reinvest in equipment, where does that show up? That's net capital spending, okay? And that's going to show up in our cash flows, okay? We're going to run that out of our, when we set up the table for cash flows, you'll see it, okay? But it doesn't show up, it's not going to show up on our income statement. All right, so we have 1,000,008 less 620,000 less 194,000. How much is that? Somebody tell me. Nobody's answering. Hello? You guys there?
2,614,000.
Say again. 2,614,000? No.
No, you should. I got 986,000.
Okay. Why are y'all taking so long to respond to me? You afraid to answer? Don't be afraid to answer. All right. Let me get my calculator out. Clear this thing out. 1,800,000 minus 620,000 minus 194,000 is 986,000. And taxes are 20%. All right, times 0.2 is 197,200. All right, so OCF is equal to EBIT, 986,000, plus depreciation, minus taxes, so what do you get?
$982,800.
Right. $982,800. All right, so that's our operating cash flow. All right. Now, I'm going to make a simplifying assumption here. So let's do this. OCF is 982,800. All right, so we can go ahead and erase this. I've got my electric cord set up here and it's right in the way. All right, so I'm going to make a simplifying assumption here. What we're going to say is that CF1 to CF10, okay, this is a 10-year project, involves a cash outflow, net capital spending of 200,000. Let's see. Let me run up here. Yeah, 200,000. Now this could get a little sticky because the 200,000 that we spend to reinvest in our equipment, that would come out of our cash flows, but it would also, we could add that back into our depreciation. And I don't want to get too complicated because on the final, the question that you have doesn't do that, okay? You don't have to reinvest in equipment, okay? But in this case, you do. So I'm going to make it really simple. So we have our operating cash flow is going to be 982,800, but we're going to have to take $200,000 a year of that, and we're going to have to reinvest it. So 782,800, okay, is what your cash flow is going to be after you take the 200,000 out each year, okay? And you would get some of it back through lower taxes, because if we took 200,000 divided by 10, that'd be 20,000 that you'd add back to depreciation, which would lower your taxable income, which would in turn lower your taxes. So you'd recover a little bit of that through taxes, but I don't want to overcomplicate it. All right, the other thing I could have done was just said, you don't have to reinvest any money in there. All right, so we've got our CF0 and we have our OCF, okay? So that's all we need, and that's for time. So this is CF1 through CF10. All right, now we need to do the WACC. All right, so to do the WACC, we set this table up, sources of capital, and we only have two sources of capital, bonds and common stock. Now, the problem on the test, I think, has three sources of capital. Do not let this throw you. If there's a third source of capital, you just put it right here, preferred stock, okay? And the other comprehensive problem that is posted with answers, and I'll post answers for this, has, I think, three forms of capital, okay? So we have our sources. Now we have to find our percentage of capital, okay? And to find our percentage of capital, we have to find the market value of debt the bonds and the market value of common stock. And so let's look. So they have 6,280 bonds times 1,035. That's the current market price. You always multiply the number of securities by the market price. Some of you get confused and you think because it's a bond, you have to multiply that by par value. You do not. You multiply it by the market price. You're not confused about stock because the par value for stock is irrelevant. Okay? Market value. So somebody tell me what 6,280 times $1,035 is.
6,499,800.
All right, now if this thing works right, well, let's see. Well, that's their capital structure for the overall company. A lot of times the amount of capital that you have in here is equal to your net working capital and your net capital spending. All right, how many shares of stock do we have? 55,000 shares times, where's the current price? $63.64. All right, so somebody multiply 55,000 times 63.64. Tell me what it is.
3,500,000.
3,500,000 even?
No, 200 and $200.
That?
Yes.
All right. All right, let's clear this. So we have 6,499,800, which is pretty doggone close to 6,500,000, right? Plus 3,500,000. 200. And that's 10 million, right? Y'all get 10 million?
Yes.
That's a nice round number, isn't it? All right. So we can see right off the bat that our debt is going to be 65% of capital, that divided into that. 6,500,000 into 10 million, and 3,500,000 into 10 million, 65/35. Okay? Now we need to find the cost. Okay? So let's find the cost of the debt, which is compute I, Y. All right? So let's see, the coupon rate's 10%. So 1,000 is the future value. Always start with that because it's not listed there, but we know we're getting our 1,000 back. And 1,035 plus minus is our present value. Okay? 10%, 0.10 times 1,000 equals $100. How often does it pay? And it pays semi-annually, divided by 2. 50 is the payment. When will it mature? 10 years. 10 times 2 equals 20 is our N. Compute I, Y. And what do you get? What do you got? Anybody?
How is 10 times 1,100?
That's not 10.
That's point. Okay.
That's 10%. That's the coupon rate. Do you hear my voice crack? It's
Yeah.
That's the coupon rate times the par value is 100. And what does that 100 represent?
That's the payment for
That's the annual payment.
and then divided by 2 is the semi-annual payments.
50 is our payment. We did this in chapter 7. Okay. And then again in chapter 11. So what's our IY? Somebody started. Give me the semi-annual IY.
4.725.
Yep. 4.725. That is the semi-annual IY times 2.
9.45.
9.45%. That is our annual pre-tax cost of debt. So now we have to take 9.45. You can't stop here. And by the way, on the test, this is one of your answers. The question will be, what is your pre-tax cost of debt? And this is going to be one of the answers. And some of you are going to miss it because this is a semi-annual problem. This is your semi-annual cost, not your annual cost. So 9.45%, whoops, times 1 minus the tax rate is your after-tax cost of debt. So what's your after-tax cost of debt? 9.45 times 0.8.
7.56.
7.56%. There's your cost. Okay. All right, let's erase some of this to make room. Now we're going to have to find the cost of common stock. Okay, we're going to use the Gordon and the CAPM. All right. Stock has paid the following dividends: $1, $1.35, $1.80, $1.60, and $2.25. Stock's trading for 63.64. Stock has a beta of 1.3. Market expected return. Let's do CAPM first. So CAPM is equal to the risk-free rate plus beta times the expected return of the market minus the risk-free rate. And the risk-free rate is 2.5%. The beta is 1.3. The expected return of the market is 10% minus 2.5%. Okay, so we're going to do this first. So we have 0.075 times 1.3. So what does that equal? What's 0.075 times 1.3? It's an easy calculation. 0.075 times 1.3. Let's hear it.
0.0975.
Point what?
0975.
0.0975. Okay. Plus 0.025 is equal to what?
0.1225.
Do what?
0.1225.
12.25%. Okay. Now we're going to do Gordon. And Gordon is K equals D1 over PO plus G. And you're going, why did Dr. E list 5 dividends. Why did I list 5 dividends? Do I give you the growth rate? No. Why did I list 5 dividends? What do you think? What can you calculate with these 5 dividends? $1 was the first one, and $2.25 was the last one, the most recent one. What can I calculate with that?
Kager.
The CAGR. Okay. So, because D1 equals DO times 1 plus G. G is CAGR. Now, I could say G is also SGR, but we're not going to mess with that. I think on the test you do have to calculate SGR. But let's do CAGR. So we have 2.25 divided by $1 raised to the 1 over n, and n is 1, 2, 3, 4, 5 minus 1 raised to the 1 over 4. Okay? Minus 1. So 2.25 divided by $1 equals YX 4, 1 over X key, then equals, then minus 1. And what's the CAGR? What's your CAGR?
0.2247.
0.2247 is your CAGR. So that number is going to go right there. Now we have to find D1. D1 equals DO times 1 plus G. DO is 2.25. That was the last paid dividend times 1.2247. DO times 1 plus CAGR is D1. So what's D1? $2.25 times 1.2247. What is D1?
2.76.
2.76. So K is 2.76 D1 divided by PO, which is 6364. And what is that? 2.76 divided by 6364. What does that represent? D1 over PO equals what? Not the number.
Dividend yield.
Dividend yield. Okay. Plus G. And G is 0.2247. Okay. So what is that number? The dividend yield plus the CAGR. So what's 2.76 divided by 6364? What does that equal? Come on. Some of you aren't answering, and that's just a math question. 2.76 divided by 63.64.
0.0433.
0.0433 plus 0.2247 is equal to what?
0.2681.
0.2681?
Mhm.
Okay. All right, so let's add these two together. 0.2681. The cap M is 12.25 and the Gordon is 0.2681. Add them up. So what's 0.2681 plus 0.1225? 0.38.3906. Is that what that is?
Yes.
0.3906, and divide it by 2, because we're going to average. There are 2 ways to get our cost of equity. One is CAPM, and the other is Gordon. So we're going to do it both ways, and then we're going to average them, because we got 2 very different numbers. This is much higher than this. So we're going to add them up and divide by 2, and what do we get? 0.1803. Is that right? No, I'm sorry. No, I'm way off. 0.1958.
5.3, but yes.
0.1953. All right. So we have 19.53%. Okay. All right. Let's erase all this stuff down here because we've got what we need now. I hope we don't run out of time on our video, on our Zoom. I don't think we will. All right. So we're going to multiply 65%. So weighted cost. .65 times 0.0756. What does that equal? So 0.65 times 0.0756.
.049.
Okay. 0.35 times 0.1953. What is it? 0.35 times 0.1953. What do we get? Somebody. There's 17 people watching, and so far I've heard only about 4 voices.
0.0683.
Let's add them up. Okay. So we have 3, 9 and 8 is 17, 1 and 4 is 5, 5 and 6 is 11. 11.73%. What is that? That's the WACC. NPVI equals the WACC, which is that number. All right. Now we have all the information we need to do the internal rate of return and the net present value. Okay. So let's get our calculators out, clear them out, and hit the cash flow key. And I've got some numbers in there, so I'm going to hit second, future value, second, CEC, and CEC again. Cash flow key, scroll, hit the down arrow 3 times, we're good to go. All right, so CF0 is equal to 2,840,000 plus minus. It's a negative. 2,840,000 is what we're spending, so it's a plus minus. Enter, down arrow. CO1 is $782,800. Okay, and enter, down arrow. How many times are we going to get that? Well, we're going to get that 9 times, okay, because in the last year, we're going to recover our net working capital of 900,000. Okay, so we're going to get this 9 times. So we're going to say FO1 is equal to 9. Enter, down arrow. What is CO2? $782,800 plus the 900,000 in working capital that we said we were going to get back. Okay, So that's going to be $1,682,800. $1,682,800. Does everybody see what I'm doing? It says they will recover all of their working capital at the end of the project. So what was our working capital? It was the rent and advertising and accounts receivable. It was $900,000. So in the last year, we're going to get this, plus we're going to get our $900,000 back. And that's $1,682,800. Enter, down arrow, and down arrow. And now NPV, I equals 11.73. Enter, down arrow, and compute. And what do you get?
1,929,165.
That's not what I got. I got a different number. I got 1,374,113. Let's try it again. Hold on. Let's try it again. I may have gotten off. I may have gotten off. Hold on. Let's put these numbers back in because I may have put the wrong number in. I think you're right. But let's do it. 2,840,000 plus minus, enter, down arrow. And then we have 780. Using this calculator on the phone is really cool. Do what? 2,840,000 plus minus. Enter, down arrow. What's happening here? 782,800. Enter, down arrow. That's 9. Enter, down arrow. CO2 is 1,682,800. Enter, down arrow, and down arrow. And NPV, I equals 11.73. Enter, down arrow, and compute. Yeah, 1929. I'm not sure what happened. It was in there, right? 1929. 1929 166. Right? Is that what you got?
Yes.
Yes.
Okay. If we were looking at this project, would we do it? Would we do it? What's the rule when using net present value? Anytime the net present value is greater than 0, you do the project. And if one project creates more value than another project, you do that project, the project that creates the most value first. Okay? Now, hit IRR, compute. And what do you get? 25.57%?
Yes.
Okay. Would you do this project using the internal rate of return? What's the rule? The rule is anytime the internal rate of return is higher than your WACC, your cost of capital, you do the project. Yes, we would do this project. Now let's make one adjustment. Let's say that this project is 20% riskier than the average project, okay, for the company. This is the WACC for the whole company. This project is 20% riskier. What kind of adjustment do we make? We're going to take the WACC and we're going to multiply it by 1.2. 0.1173 times 1.2 is equal to 0.14076, right? Okay. You got that?
Yes.
So this is the cost of capital that's been adjusted for risk. If this project was 20% less risky than the average project, then it would be the WACC for the average project times 1 minus 0.2. So where does that go in? We go back to NPV. I equals 14.076. Enter, down arrow, and compute. And what's our risk adjusted NPV? What's our risk adjusted NPV?
I got 1,472,250.
That's it. That's it. Okay. So that's the risk adjustment. All right. That's will the internal rate of return be affected by the risk? No. No. Well, it will from the standpoint that this rate goes up, and now this has to be higher than this instead of being higher than that. Okay. This is your new hurdle rate or discount rate. All right. When the Federal Reserve decides to lower interest rates, to put money into the system to lower interest rates, you know what goes down? The cost of debt goes down, which lowers your cost of capital, which means that more projects will get done. That's how it stimulates spending. Companies are doing these calculations, and if 11.73 goes to 10%, projects that now have a 11% rate of return will get done. Before, with the higher cost of capital, they weren't getting done. That's why the Federal Reserve lowers interest rates to stimulate the economy. All right, let me sit down for a minute because I am getting old. And let me scroll over here and look at the final. And so there's the final. Don't you wish you could see that final? All right. So the first 25 questions are all related to that. Okay. So I walk you through the entire process. Okay. And then there are a couple of questions from chapter 1 about business organization and who does what, you know, the board and all that. Then, yeah, there's a question about, there's a basic question about what an asset is worth, which is one of the two principles of this course. Remember those two principles I told you at the very beginning that I wanted you to remember. What are the two basic principles of this course? Then there's some information about the financial statements. You got to match up some financial statement information. Oh, you need to know about ratings, bond ratings. You need to know what they mean. Oh, there's a house problem. There's a house problem. Imagine that. You're going to have to find what your payment's going to be, how much the bank's going to loan you, what your payment will be. Oh, you have to know what happens to level pay loans with regard to principal and interest over the life of the loan. You better know that. A lot of you missed those questions. Man, those are layups. Relationship between risk and return, that's the other premise. Value of an asset and the relationship between risk and return. The relationship between inflation and interest rates. The relationship between interest rates and bond prices. Let's see. Here you have to do the 3 profit margins, asset turnover, asset. You have to leverage. You're going to have to do DuPont return on equity. You have to know the relationship between interest rates and PE ratios, and earnings growth and PE ratios. You need to know what are the components of a best case scenario and a worst case scenario. A retirement planning problem. Okay, you're going to have to do some retirement planning. How much you're going to have to save? How much do you need to retire? How much you're going to have to save every month? Sensitivity versus scenario analysis. Oh, you're going to have to value a stock. You're going to have to calculate multiples. a multiple. You're going to have to calculate CAGR. You're going to have to, and then forecast the price using the multiple and the fundamental. Yep, there's earnings per share. So I give you a few years of earnings per share, and then I say, what's your forecast for next year? You got to do CAGR. Then I give you stock price, and I give you earnings per share. You got to do the multiples. Man, I'm giving this freaking test away. All right, then here's another. You got to do an income statement, and then you got to do a balance sheet. There's one question about economic systems, and then you got to know that the last slide in chapter 1, which has to do with a cash flow. What do companies do with their free cash flow? All right, I just gave you the entire exam. You don't make 100, I'm gonna be mad. That's it. That's the whole exam. All right, let me get out, exit full screen, and then let's go to gallery view and see who's sleeping. Riley Fox has not moved the entire time. It's amazing. All right, there's Audrey. She's asleep. Her feet are up. I think I heard her snore. She got her hair pulled up. What's that thing on top of her head? She's got a big bump on her head. There it is. All right. And all right, you guys have any questions? No? Was that good? Did I help you? Tell me the truth. How many of you are more scared now than you were before we did this? No? That's good. All right.
I got a quick question, Dr. E.
Yes, sir.
How do you come up with that number 782,800, the CFO number?
This is our operating cash flow right here. EBIT plus depreciation minus taxes. Okay. This number here, it says in the problem that they're going to have to reinvest $200,000 a year in equipment. Their equipment wears out, so they're going to have to spend $200,000 a year to maintain and buy new equipment. Okay, so that is net capital spending. So now on the final, you will not have any reinvestment to worry about. Okay, this number will not be present in the problem on the final. But in real life, you got to reinvest in the business, and that takes away from the operating cash flow. That's money you have to reinvest is money that doesn't go in your pocket. And you're valuing the business based on free cash flow. Okay. So in a real situation, this amount grows, and also your working capital grows. As the business grows, you got to spend more money on working capital, so this number gets even smaller in real life. Okay, that's why it's 782,800.
Thanks so much.
And the reality is that if you spent $900,000, the only amount of money that you would recover, if you spent $900,000 on the front end on working capital, the only amount that you would recover would probably be you get your accounts receivable, and you'd sell the rest of your inventory, and you fully depreciate the assets. You'd sell some of your assets at the end of the project, but you'd probably get maybe 20 cents on the dollar for them. You'd recover that. So I don't know if you'd recover all 900,000, but in advanced finance, we go over a case that's more complex, more real life. So they say, okay, you're shutting the business down. What will your cash flows look like? Let's say you sell your equipment for 20 cents on the dollar, and you've got, at this point, you spent $200,000 for 10 years. So that's $2 million in equipment plus what you spent on the front end of roughly $2 million. So you got $4 million worth of equipment. You're going to sell it for 20 cents on the dollar. You get 800,000. See what I'm saying? But it gets even more complicated than that, because you will have fully depreciated it, which means if you got 800,000 in your depreciation but you fully depreciated it, you'd have to recapture that amount. So the 800,000, you'd have to take taxes out of it. So 800 times 0.8, you get 640 back. But that's for advanced finance, which I hope all of you will take. But if you liked this class and you can fit it into your schedule, advanced finance is all cases. It's fun. It's all cases. We have one exam at the beginning that just goes over some concepts, but the rest of it is applying what we learned in ManFin to solve business problems, business cases, and it's fun. So anyway, what other questions?
What's the deal with note cards for this test?
You can have one note card for each of the previous exams plus 2 for this final. How about that? So basically you can bring in a book. So front side only, 4x6. What do we, is this the 5th exam? So you're bringing in 10
Sixth.
cards. 6th exam?
6th exam.
Yeah. So you're bringing in 5 times 5 and then 2 for the 2, so 7 cards. 1 card for each previous exam and 2 cards for this one. So 7 cards. What can you put on there? You know what the rules are. Anything. You might want to write down one of the comprehensive problems. Just thought. But I told you the other stuff that's going to be on there, and so you know, you need to have a good card from, you know, there are a few questions from chapter 1. You don't have to have, you know, half a card will probably get you chapter 1. Half a card from chapter 2 because it's just the financial statements, and then half a card from chapter 3 because you're going to have to basically be able to do the ratios that are involved with DuPont return on equity, you know. So, but those relationship questions, you know, how things work together, you need to know those things. Okay. PE ratios and earnings growth, PE ratios and interest rates and bond prices. That's how our system works. So I really want you to understand those relationships. But when you get out in business, if you're in a meeting and someone says, what happens if interest rates go up? And you sit there and go, I don't know. Woo, that's not going to look good. You know, you need to understand that's a basic of business that you need to understand. That's why ManFin is a core class, because regardless, or some people say irregardless, which isn't a word, regardless of what area of business you go in, you need to understand some basics. What else? Is that it?
You might have said this.
Say again, please. Do what?
I was going to say you might have said this already, but did you say that the test was going to be like 50% test 6 and 50% cumulative, or is that not accurate?
Well, probably pretty accurate. There's 65 questions, and honestly, you know, again, you're going to have to do an income statement to do EBIT. So, you know, the cumulative, it's cumulative, you know, and you have to know how to do chapters 1 through 8 to be able to do chapters 9, 10, and 11, you know? So, but I've gone over all the cumulative stuff. I listed it for you. So the first 25 questions are straight out of 9, 10, and 11, and then there are probably another 10 questions or so that are related to 9, 10, and 11. So that's roughly 35 questions, I would say, and then the rest of it is just cumulative. And you know, but I went over everything that you're going to need to know.
Thank you.
Sure. So if you have any questions during the remainder of the week, just text me and I'll get back to you. Okay. So I'll post answers. I'm not sure how to handle the recording on this thing, but we'll figure that out. I'll figure that out and post the recording of this. But I have the recording of the other comprehensive problem, me working the other comprehensive problem. And I'll post the answers to this, and I'll post the answers to the other comprehensive problem. Okay? All right. Yes.
How long we have to take the exam? You said it's going to be open. I think you said 3 to 7 p.m. But how long will we have to actually take it?
I think, is it 3 to 7? Okay.
3 to 9.
Yeah,
3
3 to 9. 3 hours. You know, and on it, there's 65 questions. So it's 180 minutes. It's roughly 3 minutes per question. And I would think that would be more than enough time. I could make it 3.5 hours. Why not? I don't want anybody to run out of time. I don't want time to be an issue. I'll make it 3.5. See, Megan, you twisted my arm. You're a great negotiator.
Thank you.
How many points is it worth?
I think it's worth 20. I think it's worth 4 points more than a regular exam. And you can look up look it up on the syllabus. But I think it's worth 4 points more than, like, let's see, 2 of the exams were worth less because they weren't worthless. They were worth less because I split up. There were 1 chapter, 3 and 4 together are worth the same, or should be worth the same as test 1 and test 5 and test 5. Okay, that's how I did it. So this test is just a little bit overweighted because it's cumulative, but not much. Not much. What else?
When will we know what the cutoff for an A or a B will be?
Well, I mean, you see the spreadsheet that I posted last, and it's got the grades up through the test 5, right?
Yes, but you had redone the test 4, so like you would let people retake it. So
Yeah. Oh, did I
and you
not
said
show
you were-
that?
not as
I
far
don't
as
think
I've
we have-
seen.
Okay.
Yeah, I don't think we have an up-to-date one with all the correct
Okay.
scores.
Yeah, I did that. I guess I just didn't post it. Let me look at that. I'll get that posted tomorrow, so you can see where you are. I'm trying to think. How many of you guys retook it? I think that if I recall correctly, a lot's happened. I think only 7 people retook it. There were lots of people who made in the 60s. They didn't retake it. Go figure. I don't know. I mean, I thought I was doing something good, but it didn't turn out that way. And I talked to a couple of professors about doing it, and they laughed and they said, it's not going to help them. I said, well, I want to try. You know, so. And, you know, and if you made a high grade the first go round, you had absolutely nothing to gain by taking it. I didn't expect anybody who made a 90 or above to retake it. But man, I thought everyone who made below your average grade for the semester, if your average grade was 88 and you made 82, I figured you'd retake it, try to pull your grade up. But that didn't happen. But, you know, it's complicated. I know y'all are trying to balance a lot of different things. I've had a couple of students open up and be honest with me and tell me they're not motivated. I understand that. Some people are working. I understand that. There's a lot of complications. This is not an easy time. And so I get it. I'm not browbeating anybody, but I just kind of wish that more people had retaken it. I wish it helped them. But that's okay. It is what it is. So I sure hope we get back to normal. We're all ready to get back to normal. All right, what else you got? That's it. All right, well, I may schedule one more Zoom just to sign off, but I appreciate you guys. I appreciate y'all signing up for my class. And I appreciate you hanging in there. I know it's been difficult with going online and staying focused and engaged. And we got, things are starting to open back up. If you're not a friend of mine on Facebook, I encourage you to friend me. I provide a lot of commentary, and anything you disagree with, as is always the case, whether it's in class or on Facebook, just say, I don't agree with you, and here's why. And I'd like I like for people to disagree with me, as long as they don't say you're a moron. But that's what I tell people when they don't know economics. When people say things like, we shouldn't open the economy back up. All right. And that's how they look at it. Well, there's a lot more to it than just we shouldn't open the economy back up. There's multiple dimensions to these issues, and so many people just focus on one thing. Well, old people might get sick and might die. We need to keep the economy shut down. It is much more complicated than that, folks. So, and watch out for those hypocrites. Watch out for those hypocrites. Blase Ford all she knew was that Kavanaugh raped her. She didn't know the date, the time, the place. She had no corroborating evidence, and yet there were people screaming, you got to believe all women. And then this girl, Reed, comes forward and says, Biden assaulted me, and she told several people. She reported at the time. She knew the date, the time, the place, and she told people about it immediately, and the Democrats said, we don't want to hear it. That's hypocrisy. Republicans do that, and Democrats do that. You young folks, you need to hold everybody accountable, and they need to be accountable to the same standard, even if it hurts. If you're a Republican and it makes your candidate look bad, so be it. If you're a Democrat and it makes your candidate look bad, so be it. One standard. Everybody's judged by the same standard. And that's part of being a Christian. We know better. We know better. All right. That's all I got. Love you guys, and I'll schedule one more meeting. All right. Text me if you have any questions. Thanks.
Bye. Thank you.
You bet. Glad to do it.